Hi, my friends, Lee Bricky here, and nationwide inventory is up 40%, which is a whopping increase and the biggest increase we've seen in 1 year. Also, price reductions are up 41% nationwide. And here in Florida, we're seeing both those numbers much higher, and we're going to get into that in this video. But all of this is caused by, obviously, unaffordability in the real estate market, rates going from 2% to over 8%. And also, we're in this election season, which people are saying that they're holding off till the end of the year. And then we're seeing that this is a seasonal thing that happens every single year. So all of that combined, we're seeing a slowing market. So in this video, we're going to bring on our good friend Brent Starts from Unitas Lending, and he's going to help us shake out all of these numbers and all of the information you need to know with what's coming down the pipe with rates and with prices. So don't go anywhere. But before I bring on Brent, if this is the first time you've been to our site, go ahead and slap that subscribe button, ring that notification bell so you don't miss any of our real estate tips and tours, because here in this site, we talk about everything luxury real estate in Palm Beach County and the Treasure Coast. And we have market updates that tell you exactly what you need to know about the market without any fluff or craziness that you're seeing on other channels out there right now and in the news. So with that being said, let's talk to Brent. Brent, how you doing, man?
Doing great, Lee. How are you?
I'm doing awesome, brother. So you heard the beginning of this. We're looking at a real estate market that has been just, I would say in the last 5 years, something that we've not really been able to predict. I mean, and then, you know, we saw government get involved, the Fed get involved, hold rates back too long is the consensus. And it seems like they're starting to move forward now to keep us from getting into a recession. Yeah, and job numbers have really changed also, because we're seeing over a 4% unemployment rate, which is higher than it's been in a while. And so I think the Feds, you know, came out and telegraphed that they're going to do something about rates. Could be a quarter, could be a half. We're going to talk about that. But get into it right now. You know, where are we seeing rates at right now? Because I know that rates have dropped down into the sixes already. And we actually saw that cause a little pickup in the market. Home sales actually moved a little bit and started to pick up just a tad. So what's your take on rates and where they're heading?
Yeah, it's interestingly what we've seen and what's really helping people out, and what the uptick in the market. You know, rates were right around, like you mentioned earlier in the intro, were right around 8%. Just several months ago, and we're in the mid sixes right now. And having that happen, the affordability. Someone that was looking at a maximum of a $375,000 home, they're looking at 430 right now. So it does make a difference in the affordability picture. What you can purchase, and like you say, there's more inventory now, so it's definitely freed up the market a little bit. The inventory is actually, giving borrowers choice or buyers choice. So that's really strong. And what you mentioned about the employment figures, if you've noticed, I just got off the phone with a borrower just minutes ago. And, she says, what about these job numbers? They keep getting revised down. And this last revision, was the year over year figure. It was revised down 818,000 jobs. So, it's pushing 1 million jobs that we thought we created, but we didn't. And so those job figures, if you notice, they revise previous months down when the jobs report's released once a month. And that's a kind of a rear view mirror look into the economy. So the Fed wants to get ahead of that. They see that the job reports weren't as strong as what they had thought they were over the last year. And they kind of need to get on this as opposed to waiting. And that's why the sudden change in tone at the Fed meeting, because we look at the notes of those meetings, actually the minutes of those meetings, and the conversation is, hey, is it 25 basis points or 50 basis points? In other words, a quarter reduction or a half reduction. And at the time of this recording, we're looking at about a 63% chance of a quarter point cut, and about 30 some percent as far as a half point cut. That's kind of baked into the market right now, and that's what brought those rates down to mid sixes.
So Brent, talking about that, talk about this target rate probabilities chart for September 18th from the Fed meeting.
Yeah, this is a great chart, Lee. And what it does is it looks at the futures market and shows where bond traders are looking as far as, hey, where they're betting in a quarter point cut in the Fed meeting September 18th, or a 0.5% cut, or 50 basis points. And what the chart says here, if you look at the chart to the bar, the one to the right, it's 63.5%. That's the likelihood of a 0.25% cut in the Fed funds rate. And so that's what the futures market is telling us. That's what the bets are, if you will, that it's going to be a quarter point hit September, or a reduction September 18th. The 475 to 500 basis points target rate for the Fed funds is 36.5%. And what that means is 36.5% of the folks betting on this rate cut think there's going to be a half point cut. Right now, it's 5.25 to 5.5 is the Fed funds range. And so that's what this chart's telling us. And those are the bets. So to give you an example, September 18th, let's say interest rates are cut by a quarter, 0.25%. That's already 100% baked in. That's going to happen. If they only cut rates by 0.25, mortgage rates will actually go up that day. I know that doesn't make a lot of sense, but because some of the futures trading was showing an indication that there would be a possibility of a 0.5% or half point reduction in the Fed funds rate, it missed that cut. So that's, we watch it in real time. There's a lot of reports coming out between now and September 18th that could change these probabilities. Matter of fact, it will change to some degree, but that's what's baked in right now. So that's what people are, that's what the market is telling us, that's what's anticipated. So mortgages have already adjusted to this likelihood. That's why
Right.
we're in
So that's a big point for people to understand, because I think that a lot of folks think, hey, I'm going to wait to purchase until the Fed starts lowering rates. But when the market saw those job numbers, the future started moving, and people started,
Right.
The investors started going ahead and investing on the futures of the market. So the rates, like you say, that's already baked into what we're seeing right now.
Right.
And it caused a little bump. If you look at this chart, it caused a little bump. The year over year, Zillow's forecast now is thinking prices will grow maybe 1% nationwide. We actually saw the first price increase in months just happen, where in July homes rose. What people also need to understand watching is that inventory is up right now 50% 40% nationwide, and that's still lower than pre-pandemic levels.
It's important, very important point. It's
right.
Relative to what, right?
Right, and that's the reason that experts believe that if you're waiting on a crash, it's not going to happen, because yes, there's a lot of inventory out there. Yes, some prices are decreasing in some markets and in some areas, but you go to places like New Jersey and they got no new construction and basically no inventory, and things are flying off. Homes are flying off the shelves still. So you really have to look at your market and see your market and have somebody who understands your market to kind of guide you in these numbers and really do the research, because when you start looking at these national numbers, some markets are totally different than others.
Right. Very true. That's a great point, Lee. It's very local.
Right. So let's talk about where this is happening. If you look at this chart that Zillow put out on that price metro level home price change between 24 and 25, they put out a great chart, and it has a little color arrow there on it. And if you look at the different markets, pretty much across the United States, markets are holding steady on prices. Mm-hmm. And then you look at places like some places in California where we're seeing people move out of the state. You can see those prices are starting to drop. Also, we're seeing Louisiana. There's a lot of price drops there. Baton Rouge, they're expecting 3%. New Orleans are expecting 6%. Austin, Texas, that's another one. That was a huge market over COVID, and now
Mhm.
a lot of people are moving out of that market. And so you're seeing, Austin, Texas, they're expecting almost a 3%, negative 3% change in the market. But in markets like Knoxville, New Haven, Syracuse, and Hartford, they're expecting the markets to continue to grow anywhere between 2.5% almost to over 4%. And then here in our state, pretty much the whole state seeing prices stay pretty stable. They're they're looking at prices staying pretty stable, maybe moving a little bit, maybe that 1%, until you get down to Miami, where you have so much tech and investment moving in, and they're expecting prices to continue to go up. So,
Right.
and then the market has not slowed in Miami, by the way, at all. I mean, it's still moving very, very quickly. And it seems like the lower end homes right now in Florida, in the 3s and 4s, that stuff is selling. And then the middle of the market's kind of slow right now. And then when you get up into the luxury market, 5 million and up, that stuff is moving. What are your thoughts on where rates will land? Because that's I think an important place for people to understand that, right now rates are in the mid 6s. When do you think we could see a 6%?
That could happen, within the next 6 months, I believe. I think, we've seen, the important thing is, and the big change is when the Fed pivots. That's the big news, and it's already happened. They're already telegraphing, rate cuts, and that's a big change to what they were talking about, over the last year and a half, 2 years. And so we're already seeing that. We're already in a refi boom over here, so it's already starting. We have loans that we're seeing that were in the mid 8s, and because of credit scores and things like that. Now they have a mortgage on their credit report. Their credit scores have come up, and they've built some equity. And so we're looking at refi, and that's definitely picked up here in the last week or two. So we see an immediate response to it already. Hey, where would it be? The call I just took a few minutes ago, they're in the 9s actually, but because of just circumstances that they were in at the time they purchased their home. So those people are looking to come down. They're going to save $900 a month, this individual. So so it's already starting from a refinance perspective. We're seeing that market come back. So at 6.5, a lot of loans make sense to refinance, and so that'll free up money, and it'll free up affordability, moving from 8 to a 6.5. But I think the next 6 months, I hear a lot about waiting until the election's over, and there's that's the executive branch. Fortunately, we have a 3-prong system where we have the legislative and of course the judicial branch as well. So it's not based exclusively on the executive branch, but
Right.
It does have impact. Yeah, so you'll see ideologies are different, and so that could move the market a little more one way or the other, based on projections on, frankly, inflation.
Right.
If we pump more oil, that type of thing, cost to make goods and transport them will reduce, and then that would give some more breathing room for the Fed to continue lowering rates. So that will impact a little bit, but not tremendously. I don't see that being a major factor. I don't think it's any reason to wait to purchase a home. Certainly, if values go up and down, or up an average of 4% over any 20-year period, a $500,000 house is going to be up $20,000 every year. So it still makes sense to purchase a home. It's just picking your spots. Everyone's going to pick a perfect bottom or a top, right? But
Right.
I think generally speaking, if you look at interest rates over the long picture, last 80 years, 7% is actually a decent rate if you're looking over the last, like I say, 70, 80
Yeah,
years.
I mean, I know, and people say that, but I have to like counter that one with, we've never seen home prices so high. I
Right.
mean, my son, has a great job. I mean, the sheriff's department's giving him a huge raise, and he's making strong 6 figures. So if you're a young man or woman out there and you're looking for a great job, law enforcement in Florida right now is paying big money. I mean, everywhere.
Right.
He's doing plus you walk with a 90% pension for the rest of your life after 25 years or 26 years. So
Right.
you just, some of these guys are leaving with $250,000 a year. So it's if you're looking for a great job, law enforcement's a great job.
Right.
But he's doing really, really well. And he's up in the Orlando market, and he it'd be half his income to buy a house right now.
Right.
So right, with rates as high as they've been. So, but with that being said, also, do you think that we'll break that 6% mark? Because I've been listening to guys like Bear Habib that you listen to and many others, and they really believe that we're going to get stuck at 6% for a while. And it's going to take a long time if we, see, maybe we'll see, the fives, the high fives, but getting back to where we were at, 4.25, they say that they don't see that happening, not for
It
a
would
long,
take,
long time.
no, actually, if we see 2.75% 30-year fixed mortgages, we've got bigger problems typically.
Right.
For You know what I mean, for interest rates to be cut to that, and that was basically in response to COVID and shutting everything down and getting
And they just
basically.
left it for too long.
Yeah, they just left it for too long. That's exactly rightly. And so the unintended consequences of that, they didn't pull the punch bowl away in time, and so there was a lot of money slushing around out there, and so it causes inflation, and then you have to overreact and raise rates to a level that really it's unsustainable to the jobs market, and that's what we're seeing now, where that's being beat up pretty bad. I think we're already in a recession. I think the constant revisions backward looking jobs reports. I mean, 818,000 jobs taken off the table that were we presumed as created over the last 12 months are taken off the plate. You know what I mean? And so to give you an idea, just to give some perspective, we need 175,000 new jobs every month just to keep up with the growth of the population. All right. So you need 175,000 new jobs in our country at the population level it's at. And when you take 818,000 jobs that were created supposedly over the last year and you remove those, that's a tremendous amount of that 175 you need every month, and really puts us in a weird spot. So the Fed is definitely pivoting for a reason. That was a big revision down.
Let's talk a little bit about the reality of South Florida right now in our market from Palm Beach County to the Treasure Coast. Palm Beach County last month in July had 1,174 closings, right? So that was up 0.9% from a year ago. So we're seeing something. Median sales price was $644,500 in Palm Beach County. That's up 7.4% from a year ago. Active inventory, 5,159 homes active inventory right now. That is a 50% jump from a year ago. That is absolutely crazy how much inventory has grown. And to think that we're still behind pandemic numbers, but it's definitely making impact in the market because homes are staying on the market longer right now. So we're seeing homes staying on the market 2 to 3 months instead of, most homes were selling within 30 days over the last few years. And I saw a article this morning in the business news where people are walking from their contracts now at a higher rate than ever before. And then when we go into Martin County, we're pretty much looking at the same thing, same kind of numbers across the board. Median sales price actually in Martin County has dropped 6.6% from a year ago, but active inventory up 49%. And I know that to be true because we had that listing. I just sold, and then we put the family into a new construction home with Mattamy, and a home that would have taken 2 to 3 days to sell over the last 5 years took 3 months, and we had 4 showings and finally sold it. So that was a miracle in my mind. But I have listings that have been sitting now for 3 months, and so do many other people. Some listings sitting on the market for a year now in the higher range, in the $1 million range. New listings are down in Martin County, and new pending sales, though, are up from a year ago. So, it's just kind of where you go. But then when you look at Port St. Lucie, was just absolutely on fire, has massively sold down. And you can see that from active inventory from a year ago is up 64% from a year ago. And then pending sales up 2.3%, but median sales price has gone up, but it's 1.2%. But I'm going to tell you, that is overall in Port St. Lucie. And folks that are listening to this that have homes and they're in, bought new construction that are in tradition, they're really seeing it right now. Anyone in new construction in Palm Beach County all the way to St. Lucie County where we're working, we're seeing these builders are throwing these huge incentives out right now. So if you're looking to buy new construction right now, there are massive incentives going on with new construction, and they're doing it because no one's walking on their properties, and they're just not selling homes. So all of a sudden, they started dropping these big incentives over the last few weeks, and they're seeing a pickup in sales. But in those communities, people have lost $50,000, $100,000 worth of equity because of this. So
Yeah.
I know it's a bad thing right now, but you'll agree with me on this that, purchasing a home, it's eventually going to come back. As some of these communities like Del Webb are about to close out, and within the next 12 months, once the community closes out and people start selling their homes again, the market starts to come back a little bit. The equity will go back up. Do you not agree?
Right. 100%, Lee. It's as they close out a development, typically they put loans on a lot of builders, but the mid to smaller builders, they'll put a loan on it, and they pay their construction loan down in the last, where they make all their money is in the last stretch. So they really, I've seen incentives go way up with some of the builders here in South Florida, just specials offered every week, things like that. And I'm just seeing it where they're definitely looking to make some deals for sure.
Yeah, right now Del Webb and Port St. Lucie, they're selling villas and small homes in the 3s and low 4s, and then Mattamy and some of their communities, they just put $50,000 on some of these houses.
Yeah.
And then depending on where you go, if the home's been sitting for a while, the incentive's 40, 50, 60, $100,000. It's just crazy, depending on where you are. When you're in Palm Beach County here, I mean, these homes that are starting at $1 million. Some of them have $100,000, $200,000 with incentives on them. So,
right.
So that is definitely a thing. So, what would you tell someone, Brent, that is thinking about waiting, and someone who's thinking about buying?
Yeah, that's a great question. I think right now the market's already, or the bond market, if you will, and interest rates have already responded to the shift in the Fed's stance. And so we see a 1.5 reduction in interest rates. That's a big cut. And I think that when the Fed actually has the meeting where they're going to come out and announce the cut, and a lot of people are going to be shocked that hey, the mortgage rates didn't change that much, or they could even go up based upon whatever news comes out that day or between now and then. But I think the big reduction in interest rates has already happened, and I think that it's going to be a slower ride down. Rates go up faster than they come down, essentially. But however, with that big reduction in the jobs report and that revision downward, the big reduction's already kind of taken place, and people are surprised actually. Like the conversations I've had with people today, they're getting started to refinance now because they didn't, saving $800-900, or they're paying off credit card debt, $80,000, and one person's paying off $80,000 in credit card debt that went up.
And that's a big deal, because when the Fed makes this rate cut, that's really where people are going to see it. They're going to see it in their credit card debt. They're going to see it in their car loans. That's where they're really going to see it. That if the lower they can get the rates for credit card debt and car loans, the better off people will be.
100%. There's over $1 trillion of credit card debt. To get your head around that, that's a million times. And so it's that's a tremendous amount of credit card debt, right? And so when you have that, an average 24-25%, it impacts, the prime rate. So in other words, I'll give you an example, right? Prime, it rides at 3% above the Fed funds rate. So right now that calculations, is 8.5. So if the Fed funds rate's 5.5, with the range right now is 5.25 to 5.5. So call the prime rate 3% higher than that. There's an immediate reduction when that happens. So when the Fed makes that announcement, they don't have to keep the prime rate at 3% exactly above the Fed funds rate, but all the major banks will immediately announce that their prime rate reduces by either a quarter or a half on September 18th, and you can bet my arm on it. So
Right.
It's going to happen. It's going to happen.
Right.
And so, but mortgage rates respond immediately. Now, what will happen is we'll get a bunch of calls September 18th and 19th, and they're saying, "Hey, I heard rates are dropping." And so, but that's already happened, because it's already baked into the pie, if you will. So I think that
Right.
there's going to be more awareness, in mid-September that this is happening. And so people will start to see it and hopefully, get some people some debt relief as far as, car loans and credit cards and that type of thing. With all the inflation, the last thing they need is, higher interest rates right now on their debt.
Right. So, hey, Brent,
Mhm.
thanks a lot for joining me today. And I just want everyone to know that Brent and I are going to do this every single week, and we're going to keep you updated on what's happening with money, the markets, and interest rates. And so keep tuning in. Look for this video to come out every week and share it with your friends because, if they're looking to buy or thinking about buying, go ahead and share this video. And if you have any questions or concerns about mortgages and want to know about refinancing, if you're thinking about that coming up soon, you're sitting on one of these high rates like 8 or 9%, go ahead and reach out to Brent. I'll leave his information in the information section below, like I always do. He's always there to help you, right, Brent?
That's right. Love to do it.
So I hope you liked this video. If you did, go ahead and like this video and give me a thumbs up. I really appreciate it. Helps me know that we're creating the right kind of content so you folks know what's going on around Palm Beach County and the Treasure Coast. I really appreciate it. And then also, if you have any questions or comments, go ahead and leave those in the comment section below. We'll answer all your comments and questions. We love to hear from you. And if you have not subscribed, go ahead and slap that subscribe button right there. Ring that notification bell so you don't miss any of our real estate tips and tours. Watch the next video right there. Be kind to each other, and I'll see you in the next video.